right? Yeah. All right. So this is a very good concept here because when we think about the real cost of inventory, and I'm sure some of you here would think about the purchasing cost only. All right. You're talking about inventory, Patrick. Obviously, you are just talking about how much how much we paid for the actual product from the supplier, right? It's not only that. So, for example, when we are looking at these four blocks, it's very important because this is a very good summary of your theory in the textbook. Because when you look, for example, at inventory cost, you have to look at the cost of acquisition, the cost of storage, and the cost of administration. What am I doing? I'm simply reciting your textbook. So when we look at the cost of inventory, all the costs incurred or involved are the cost of acquisition, storage, and administration. So you already see three things there. So now, when you're looking at another aspect of it, to make it simple, because we always need to make it simple for all of us, right? When we look at the cost of purchasing, it's just one of the costs. It includes the cost of transport, for example. You know this. Railage, carriage, freight, and any other cost that you can think of, right? Whatever cost that is needed to purchase an item, which could also include, by the way, you paying for taxes or import fees. Is that ringing a bell? So there is more to it than just the cost of buying an item. There's more to it than that, right? But another good block of cost that you need to think of is carrying or holding cost. Always keep that in mind. I want you to keep that in mind. Holding with an H and ordering with an O. Ordering with an H. Sorry, ordering with O and holding with an H, right? These two, O and H. Can we just do that? So keep O and keep H in mind. So when we're talking about carrying or holding costs, it is the cost of holding inventory in stock, which could include warehouse rent, insurance, spoilage, obsolescence, and the opportunity cost of capital. That's quite a lot, right? Do you see that it's not as simple as just the cost of buying or purchasing an item? There's other costs that are there that you need to be aware of. Now, let's go to ordering cost. So we have the administrative cost of preparing, issuing, and paying purchases orders, plus receiving and inspecting the items. Especially when you are in manufacturing, it's not just a matter of, yeah, we purchased inventory. No, it doesn't work like that. We purchased stock. It doesn't work like that. We also need to inspect it. And that involves cost. Is that making sense? And there is even, let's go just slightly deeper, just slightly deeper. Think about the stock out cost. That's a dreadful thing, like I said, because of the fact that if you are in the middle of production and you run out of stock, basically your production is crippled. So you need to think about the costs that will be occurring to the company when it runs out of an item. Not only we will lose money, but we might lose future business. And we might incur even more costs, for example, to expedite the shipping, because we are like, listen, we need this item and we need it now. So we are ready to pay whatever we need to pay because our customers are getting mad at us because they don't have the product they're looking for. Do you see where we're going? So I want you to see cost no longer as just the purchasing cost. That's basically what it's all about here. But two things I want you to keep is the ordering cost and the holding cost. These two are very, very important, especially when we talk about the number two objective of this evening, is that we need to find out what would be the optimal balance, right? To make sure that we are minimizing costs, because that's what we need to think of. Not only that we need to have the stock and we should not run out of stock for our production, but we want also to reduce the ordering cost and the carrying cost. Right. And that's where we come to a very important notion, the economic order quantity. All right. It is not complicated at all. It's basically what I told you, keep in mind. All are the most important thing. Holding cost, ordering cost. The D that you have there is just the annual demand that we have. Right? So we have a particular demand. We need a certain quantity of inventory or stock. That's our demand. Right? So our suppliers, we are buying from our suppliers. We need a certain quantity because our production demands a number of units of a particular product, right? Could be wood, could be leather. It does not matter. We need a certain quantity. Our production demands a certain quantity. Making sense? And then we have the ordering cost. We've already talked about ordering. Any cost that is going to be involved to get our product there in the production ready to be used. Holding cost, we are talking about, obviously, we want to have some fur. We want to have products that are there waiting to be used. So what do we need to do? We need to stock it. We need to have storage for that. Because we're not going to be buying when we need to do production today. We should buy way in advance. Do you see that? And that's all. So what we're saying when we talk about the economic order quantity is just a mathematical way. It's just a tool, right? To help us calculate the right inventory level that we need to have that minimize at the same time all these costs, ordering and holding costs. Do you understand? So it's about getting what is the what is the right inventory level we should have in order for you to do this production. But we need to make sure that we are not running out of this product too early, right? So we need to have the right quantity. Right quantity is not, what does it mean? Not too much, not too little. Not overstocking, not understocking. Does that make sense? Right quantity. By right quantity, I mean right quantity. Not over, not under. Over, we might find ourselves, we are left out, we are left with too much inventory that we don't even need. That would not be ideal. That's not what we call optimal. Remember, that's why we're using the word optimal. Optimal means just right, not over, not under. That's the objective. So if you are running whatever operation you are running out there, you want to have the right quantity, not over, not under. But at the same time, you want to minimize cost because cost, if you don't keep control on cost, it's going to impact your bottom line. It's going to eat your profits. Am I speaking financial management? Is it making sense? I'm taking a break here. Joshua, Matthew, are we on the right track? Is that making sense? Perfect. I like that. I like that. And so it's not a complicated formula. Can you imagine? This is the formula. It's the formula. So we are just saying here that this place will be the best, will be the optimal, so that we are minimizing the cost of holding and the cost of ordering. Do you see here? Oh, I love graphs. I love graphs. See, look at this graph. You can see here, it is the order quantity. We are looking at the quantity. You can see here, it's the cost. You see that. Now, in yellow here, you see the ordering. If we order in bulk, do you see that? We reduced our cost. Make sense, huh? If we order in bulk, let's say we order, let's say maybe 50,000. It's a lot, but we order it at one time. We reduce our cost. But if we ordering 5,000, 5,000, 5,000, 5,000, 5,000, the more we ordering. So if our order quantity is maybe 20 times a year we ordering, or 30 times a year we ordering, or 50 times a year we ordering, guess what? Our costs shoot to the roof. So you need to look at the size of what you're ordering. If you're ordering big at one point, your ordering cost is reduced. But now, look at the cost of holding. It goes in the opposite direction. Do you see that? So the more the quantity, the more the cost. What does this remind you of? In terms of which kind of cost is this? That grows together with the quantity. The more the quantity, the more the cost. Guys, we covered this last week. What is that called? Okay, let me give you a hint. Is it a fixed cost or is it a variable? Do you understand? Guys, come on, come on, come on, wake up. So variable, we said variable cost, the total variable cost grows together with the quantity, right? So you can see that the holding cost is a variable cost. Interesting, huh? So that's what it's all about. And the formula is very simple. So if you want to apply the formula, you just do the square root of 2 times the demand, the annual demand, multiplied by the ordering cost, divided by the holding cost. Very simple formula. It's not complicated. Don't worry. A good example is covered in the tutorial, the tutorial sections that you have on ARC, right? So another good concept, just looking at my time, right? Another good concept here. Please don't get tired. We're getting to the great stuff. This is the great stuff, right? The question that you should ask, we have just covered how much to order. Here is the how much to order. So this answers one question. How much should you order? This covers the question when to order. Remember, we said timing. Timing is money, right? Timing is very, very important. You need the lead time. You can't just order anyhow. So what is the lead time? The lead time is the time between placing an order and receiving it. Now, imagine when you place an order, it comes after 4 weeks. So, but when do you trigger that order? Because you know I need to wait for 4 weeks for that order to arrive. When do I trigger that purpose of the reorder point? The reorder point, obviously, it will have an element of the lead time. Look at this formula. You see the lead time multiplied by the average daily or weekly usage. So, for example, if your production is more in terms of weeks, right? So you will look, if I have 4 weeks to receive, the order, or I have 4 weeks of lead time, what is my usage on a weekly basis? So you need to take that into account. So lead time multiplied by the average daily usage. Let's say you using 20 units per week. That's your usage. You have 4 weeks lead time. 4 multiplied by 20 gives you 80. But you should also add, depending on if you are dealing with a usage that is not consistent. Let's say some weeks you use 38, other weeks you use 20. Do you see that? That could be a problem. So you need what we call a safety stock. You look at the maximal usage you can have per week. Let's say the maximal usage is 40. On average, you use 20 every week. On average, the maximum usage could be 40. So you can see between 40 and 20, there is a gap there of 20. That's what we mean by a safety stock. Safety stock to make sure that I have enough in case I'm required to do more than the average. Right. Does that make sense? All right. So second part, guys, it's getting better. I'm sorry if you are tired, but trust me, it's getting better. And let me make it easy. Remember when we talked about production department and when we talked about service department? Do you, all of you, understand that concept? Production department and service department. Service department are there to simply assist, right? To support the production. Does that make sense? Can you look at the picture in front of you? Is this making sense? For example, we have for this company, we have 2 departments for production. We have the mixing and the bottling. Do you see it? Mixing and bottling. But the service department that helps all departments is human resources and administrative services. Does this make sense? Come on, guys. Even in your company, you have this. You have what you call your main business aspects of the company, and you have supporting department or supporting activities that support that main activity. Is that making sense? So what we want to find out, the whole purpose of this is that this is indirect. Do we agree? Because this is manufacturing, it's production related, it is direct. This is indirect. It has an element or costs that are indirectly related to this. So the whole purpose of part 2 of Learning Unit 5 is how do we allocate this cost to this production? Making sense? All right, that's all. So if you understand this concept, be good to go. And you have only 3 things to worry about. Because we are talking about method. How are we going to allocate that overhead cost? 2, how are we going to assign those costs, those service department costs, to the actual production? We can use a direct method, meaning we are directly using the service cost and directly assigning it to the production department. Do you see that? S1 is assigned to P1. S1 is also assigned to P2. We could use a percentage, by the way. We could say 30% of S1 of HR. So meaning production 1. What is production 1 here? For this example, mixing. Mixing requires 30% only of people. The other 70% would go to the actual bottling. Do you understand? So very simple. We allocate, we assign these costs directly to the production department. Or we can use something that is more accurate. Because if you look here, the human resources also helps assist the administrative services. Because the administrative services or the administrators are also people. And it is the human services that assign those people to the administrative services. Does that make sense to you guys? So if that's the case, we should also be able to allocate some of the human resources to the administrative and from the administrative to the production, right? So with the step method or step down method, the service departments are ranked. The first allocate its costs to other service department and production department. And then afterward, the next in line. So we rank. Here we would rank easily because we have human resources will be the one that is assisting all departments. HR is assisting all departments. So we would rank it first. We would start by allocating from HR to the production and from HR to the other service department. All right, so that makes sense. And this picture is actually, it says it all. And the purpose of it is just to make sure that we have a more accurate and it's a more accurate allocation of overhead cost. It is more accurate than the direct method, but the allocation is in sequence. But even more accurate will be this method. It sounds fancy, but it is not complicated at all. What we mean is that there is a reciprocal relationship between all these departments. So, and that's why we take into account. So from service to service and from service to production department. This one, believe it, obviously because it's very mathematically sound, it is the most accurate. It is the most complex, but it is the most accurate. Any questions? Right. So almost there. We are almost there, guys. Right. So we have a traditional costing system and we have our ABC. Let me make it simple. So the traditional costing system, it's provide us a blurry view. So when you are looking at how we assign or allocate the overhead, we try to spread it in a way that is consistent, but not necessarily very accurate. So why is that? It's because we use something called the production volume, all right? And that's the flow. That's a major flow because it is volume based. So the volume based driver, and that could be, when I mean volume based, we could look maybe at labor hours. So imagine all the cost out there. We are using labor hours or machine hours. It looks easy. We are spreading everything in an even way, especially with regards to the volume. But the problem is that it's not very accurate. So traditional costing systems absorb overhead into product cost by using a single volume-based driver. Like we said, labor hours or machine hours. There is a more accurate way of doing things. And that is this one. And that's where we're going to end for tonight. But just to give you an idea, what is this? The ABC is more accurate because it's an activity-based costing. It is a more refined method. It assigns costs to products based on the activities they require for completion. I think I owe you a very good example. For example, we have inspections that we're doing for our product. Instead of saying, let's look at the volume or the number of hours the inspections will take, we can look at the number of inspections, because that would be more activity-based. So instead of saying the inspector inspected for 1 hour here, 2 hours there, 3 hours there, and then we add them up together, we can say, how many times do we need the inspection to be done? You see, so it's more accurate. And it actually reveals the true cost of each product by focusing on the activity that drives cost. So one is based on volume, traditional way, but the other one is based on activity-based costing. And this is an example in your textbook. The purpose of this, for example, for this company, it is in your textbook. I took it from your textbook, Jomo Ltd. It manufactures 3 products, Z, Y, and Z. let's compare the overhead cost per unit calculated on the both traditional system using labor hours. So look at traditional system. It's only using one thing, labor hours. When we compare it to the ABC, look at the ABC here. Again, I love my graphs. If you look at the bottom here, you have the three different products. Do you see them? Very beautiful. And then gray and ABC here. Do you see that? So both of them are parallel, so you can compare them. And on this side, on this axis, what you have the cost per unit or the overhead cost per unit in rand. So you can see for product X, it is between 20 and 30. Do you see that? Are you there? Are you with me? Thumbs up, guys, if you can see. I have only one thumb up. Are you there, guys? Does that make sense? All right, so this is just a comparison. There's no need for you to memorize. I'm just showing you from an example in your textbook. You can see that we are getting more accurate cost. Can you see the gap between these two? So under the traditional, this is the cost here per unit, 26 rand. Product X. So the total for product X we calculated and it's 26 rand. Do you see that? But the actual cost is 3 times that. Do you see that? So this is heavily undercosted by about 50 rand. Look at that. 76, 26. Almost 50 rand gap. So we can see that actually, can you imagine if you are making a decision based on this cost? So what would be the consequence? Because you are telling me, Patrick, yeah, I see that, but how does it apply in real life? It applies because if you use this to price your product X and you say, oh, the cost is only 26 rand. Okay, I'm going to price it at 40 rand. Guys, are you there? Do you see the danger? You price this product at 40 rand because based on the costing, the traditional costing, that actually I'm going to make a profit of about 14 rand. While the real cost is way higher. And so you pricing it at 40, you are making a loss. Do you get the point why we are doing this? We are doing this for you to understand that whatever you are doing out there as business, you need to cost properly your product. Are we in agreement, guys? Perfect. And that's almost the end, guys. We are there at the end. I'm there. I'm just talking to you about the last thing here. So what is the advantage of ABC? We are there. So the advantage of ABC is that obviously it's going to improve your cost estimation. It's going to make it more accurate for you to price your product. That's one thing. Once you have a good cost estimation, you are certain that your product pricing would also be accurate. It gives you a better understanding of overhead cost and what drives them. Very important. You will be able to see that beyond just say, oh, labor hours, or machine hours. You need to find what is the actual thing that is driving the cost. What is the actual activity that is driving the cost? So it provides you a better understanding of that. Another thing is it identifies wasteful, non-value added activities. So that's good because you can get rid of some activities that are not needed. It improves the product range management because Like we said here, if some product like this one, if it's not profitable, you could get rid of it. Making sense, huh? And but there are limitations. The limitations are quite obvious, right? It takes more time, it's more time consuming and expensive to implement and maintain. It requires significant data collection, of course, and it may be difficult to choose the most relevant cost driver. So it requires quite a little bit of reflection, and I come to this slide that we started with. You remember this thought? This slide is that's where we started, and we did exactly what we were supposed to do this evening. And what did we do? We looked at the valuation because we need to value properly what we have. We need to know what we have. Remember the tools, FIFO weighted average cost, because we need to accurately value inventory to determine the cost of sales. Very important. You can't move from this to the income statement. Your valuation of inventory in your balance sheet on the current asset needs to be accurate so that you can move to the income statement. The second thing we did is to optimize. What would be the right, remember that again? What would be the right amount of inventory to have that allows us to minimize the costs? Remember that? That's where we covered EOQ, economic order quantity, and reorder point. The third thing we did is allocation. We are assigning cost fairly. And we have three tools that were provided to us. We have the direct method, the step method, or the linear method. The purpose is to do what? To apportion the overhead cost correctly to the cost of production. Overhead cost to the cost of production. Because we want to know how to allocate that indirect cost, we need to assign it correctly to the actual production. And what we did in the end, we talked about precision. We want to make sure we uncover the true cost. That's where we found out that the ABC, the activity-based costing, is more accurate than the traditional, right? Guys, any questions? If not, let's call the night. Right.